expense, and that's going to be for the fair value, and that needs to be allocated to expense over the expected period of benefit. Yeah, I'm just going to get this on the, I still have to...
Just one today.
Second. Just going to get this up on the screen. There it is. Okay, so just give me a second. Just give me 1 second. It should come up in a moment. All right, while that's spinning around, this up. Now, in answering the two questions of whether or not we expense options, well, we know we will. Question is how to measure comp expense. We're going to measure it at fair value. A little bit more of that than a very simple market price. Secondly, how do you allocate the comp expense over the period of benefit, and what is the period of benefit? Well, to answer the first question, we're going to get back to these option pricing models. The second period of benefit, or the idea of the period of benefit, well, let me give you an example. Let's say you're granted an option today. Whether or not there's intrinsic value, you typically cannot exercise on the date of the grant. There's usually a vesting period. So you have to work for 2 years before you can exercise the options. Over that period of time, the expectation is that there's motivation and incentive to perform. So what we do is we will expense the options over the period of benefit, and that's the period that we believe that the incentive, the motivation is highest, and we'll write the expense off over this 2-year period. And that is the period that we call the vesting or the service period. Now, what does it mean to have a vesting, or what does it mean to vest? It means that you would be able, once you're vested, you'd be able to exercise those options whether you work for the company or not. So when you vest, that means that your ability to exercise the options are no longer dependent on your employment. If you leave after 2 full years, you could still exercise the options. If you leave before that, you forfeit. So you have to work at least 2 years. And let's say the options go out for 5 years. If you don't exercise after 5 years, they expire. This is known as the exercise period. So you have 5 years in total. The options expire if, let me just open up, I think I can open the files now. Just give me a second. I can find them on this thing. There we go. Oops, I don't want that. There we go. Give me a second. Ah, perfect. Okay. I think it's up. I think. Just give me 1 second. Push this thing off. Something just popped up on the screen. Okay. Still not opening up. Okay, forgot I can't get it. We'll have to use this. All right. So, again, you can exercise over periods beginning 3 to 5. 1 to 2, you can't do anything, you have to hold. If you leave at this point, you forfeit. If you leave during the exercise period, once you're vested, you take those benefits with you. So we will expense the options over the vesting period. Over a 2-year period, we typically use a straight line basis. So we're typically going to write this off over a straight line basis. Now, when we think about valuing the options, let me just move this up a little bit so you can see this. When we think about valuing the options, and we think about accounting for options, you have to be very careful to be sure that you distinguish between what are known as equity classified and liability classified awards. That will change things dramatically. Let me just put something over here for you so I have to do a lot of writing. And we'll get back to the valuation, how we measure fair value. Equity classified awards versus liability classified awards will change the accounting drastically. If we have equity classified awards, we value the options at the grant date. So the value that we set at the date of the grant is not changed even if market prices change. That is, even if the options go out of the money. So even if the options tank, they go underwater, even if the market price is lower than the exercise price, even if it is cheaper, less expensive to buy it in the market, you don't change the initial value. However, we do change the valuation for changes in vesting probability. Now, in order to understand this, let's go back to this timeline. If at the middle or the end of the first year, I suspect people will forfeit, I would then change the compensation expense. Why? Because this is the period that you earn that compensation. If you leave during this period and you forfeit, it changes the comp expense. But once you finish the 2-year period, that's it. You've earned the 2 years worth of comp, and I don't change the value. So if it's equity classified, I do not change the value of the award. I don't change the value of the comp expense after the vesting period is completed. But during the vesting period, if there is a change in what I would perceive to be a change in forfeiture rate, if I think more people are going to forfeit, people are going to leave the firm, they're going to walk out without vesting, it changes the compensation expense if it's equity classified. Now that's going to change a lot. I mean, there's going to be a lot of changes with that with respect to a liability classified award, but for an equity classified award, that's the way it would be structured. So equity classified, you value it on the grant date, and that is it. The only thing you might change is the changes in the vesting probability, and that is only during the vesting period. Once you're vested in the plan, you leave the firm, doesn't change the comp expense.
The vesting probability, do you have to disclose that?
Yeah, it's a good question. Do you have to disclose it? I don't see it very often. Actually, I've posted General Electric's annual report to Blackboard, but I brought it in today so we can use it. And they actually give you a way to get it, and there's lots of ways, to determine it, but General Electric is very clear. See, if the vesting probability is posted, that will help me understand your expectations as to comp expense in the future, right? And that would also, as we're going to find out, it'll also help me understand if you're going to manipulate comp expense here, right? So in 1 year, you could say you got a very high vesting probability and a very high comp expense. Next year, you change that vesting probability or increase your forfeiture rate, and what happens? I lower comp expense, and therefore I can smooth out earnings that way. So it's a real good question. We're going to get back to that. We'll get back to that with the disclosure. Okay. Now, regarding the valuation, the two models that we use. The first one is a Black-Scholes model, and that is the most common, probably the least accurate. It is only valid for about a 2-year, maybe not even, about a year out, year and a half. It is not very accurate when you go beyond a year and a half to 2 years, but it's the most popular in practice. The lattice model is preferred but not used often in practice. Now, when you look at a Black-Scholes option pricing model and a binomial model, also I should tell you, I have Excel spreadsheets in Blackboard. So you could actually value options by using the Excel model. But it's actually not that simple. The Black-Scholes model was originally developed from the heat equation in physics. Don't ask me how he thought of this, Fisher Black and Myron Scholes. But, and I used to be able to develop this mathematically more, very complicated mathematical structure. But boiling it down to something very simple, what it really does is if you think of a timeline on a present value, it takes a stock price, builds a model that might go out 3 or 4 years, has stock price volatility, dividend yield, and discounts it back to risk-free rate. That's really what it boils down to. It builds in stock price volatility, it builds in dividend yield, and how stock price will change, and discounts it back. The lattice model, you might have seen this, maybe even seen in operations or other types of statistics. This is just a very basic tree diagram where, the probability that stock goes up 60%, probability it goes down 40. The next tree, what's the next move? And then at each node, you would discount that back to risk-free rate. They consider that much more accurate. Nobody uses it, don't know why. It's just as simple. The 2 spreadsheets are right there. It's just as easy to do. But nonetheless, this is the way we measure the fair value of the options. This is how we measure the options at fair value. We use a Black-Scholes option pricing model or a binomial model, and I will obviously give you that number. I will have to give that to you. I guess in practice, you would wind up with somebody in the firm giving you that number. Firms have valuation specialists that would give you the number, whether it's an accounting firm or a financial service company. Now, once we get that, that's the way we value it. So that answers our first question, that we are now going to expense all options. We'll measure them at fair value, and we'll allocate them over the vesting period. We typically do that over a straight line or using the straight line method. Okay. All right. Now, let's take a look at an example. And I'll put this up on the screen. This is on page 5. Still want to see if I can. This thing froze too. All right, so let's look at the example. It tells you that, and I'll put the numbers right here. You're granted options to acquire 50,000 shares. I'll put the numbers in this corner so we keep on going. So we got 50,000 shares. $1 par value stock. The exercise price is 4. Market price is 4. And that's on the granted. So there's no intrinsic value. More likely than not, this is a qualified option. Tax qualified option. The employee has to work for the company for 2 years. There's a 2-year vesting period, and the options expire at the end of the 5th year. The Black-Scholes model tells us that the fair value and that has to be given to you. I'm not going to ask you to work through the Black-Scholes model. I'm going to give you the fair value. In reality, this is kind of a high number. The Black-Scholes and the binomial model on this would probably be about maybe $2 a share. So it's probably like 100,000 instead of 4, but again, that's just my assumption. And the initial vesting probability is 100%. I assume nobody's going to forfeit. So my assumption is that everybody's going to stay with the firm and everyone will, in fact, exercise or at least work during the vesting period. So I'm going to have to recognize a full amount of comp expense. Now, just a note on the deferred taxes, as you see there. We're going to come back to this. And one of the, I guess, I would think that this course is much different than Intermediate 1, is that the building is much more significant. So that what we're looking at here is going to affect earnings per share. It's also going to affect deferred taxes. Quick note, we're going to come back to this. If the options are qualified, you're going to expense the options on your books. You can't take a tax deduction. That's a permanent difference. That's going to be considered a permanent difference. So for tax purposes, you will never get a tax deduction on a qualified option, but we'll expense it on our books. And remember, I know this came up a couple of times last semester. Everyone would fall into the trap thinking that an accounting method benefits you for tax purposes. Is a perfect example of a tax situation with zero benefit, and yet you're getting an expense on your books. So it's a permanent difference. If it is a non-qualified option, you will expense it, but at a different period. So that I'm going to expense it here over years 1 and 2, but I can't take a tax deduction if somebody exercises. So the timing is going to be different. I'll have expenses first, and then I take them for tax. And that would give rise to what is known as a deferred tax asset, which we will get to. So just a note, I'm going to come back to this, and very, very quickly, probably by next Tuesday, we'll come back to this in earnings per share. A lot of this, and what we do really is to build up for the earnings per share. Now, in this example, I have two ways to account for the options. One is reminiscent of stock subscriptions. You make an entry on the date of the grant, which is optional. You don't have to make this entry. It's a disclosure entry only. It does the same thing. Negative equity and positive equity washes out. The other approach doesn't record any entry on the grant date. So let's take a look at the two alternatives. And I'm going to see if I can bring this up a little bit. Here we go. Now, in our first case, I have $400,000 as the fair value of the options. And by the way, I will tell you on, I know you don't worry about the next exam, but I will tell you on the next exam what I'm looking for. If I'm looking for the optional entry, I will tell you. If I want the other approach, I will also tell you as well. On the date of the grant, if I elect to use this as a form of disclosure, I'm going to debit deferred comp, which is negative equity, and then I'll credit APEC options, which also, or it is, positive equity. It's also described very carefully, APEC options. Once again, I normally am not extremely picky about account titles, but when it comes to stockholders' equity, you will not be correct if you don't properly disclose the source of capital. You just can't say APEC here. It's not regular APEC. In fact, it's APEC from stock options. So in this case, what will happen is that if I set up the or the T accounts, it's also called unearned comp, depending on the company, negative stockholders' equity. It's positive equity. So on the date of the grant, you debit deferred comp, you credit APEC options. Then, every year over the next 2 years, I'm going to expense. Let me get a different color so you can see that a little bit better. I'm going to expense the options on a straight line basis. A straight line amortization will expense $200,000 per year by debiting comp expense and crediting APEC options. So that over the 2-year period, I'm going to amortize this down, debit comp expense. That gets closed out to retained earnings. And I credit deferred comp. Second year, do the same thing. Debit the comp expense and credit deferred comp. And then the balance, of course, goes to zero. So that after the vesting period is over, without any changes in vesting probability, I've got nothing on my balance sheet except for the $400,000 of APEC options. The expense was already closed out to retained earnings. And again, the entry is optional. It is a form of disclosure, very much like what? Stock subscriptions. Same argument that's made for the optional entry. Any questions on the deferred comp approach or the optional entry approach? Okay, second approach. You don't make an entry on the date of the grant. Nothing's done. From here on out, you simply debit comp expense and credit APEC option. So actually I have this here, I think. 200. So every year, 2011, debit comp expense. Of course, this gets closed to retained earnings. And credit APEC options. In 2012, debit comp expense, again, 200. Close that to retained earnings. And credit APEC options. So at the end of the 2-year period, how much do you have in APEC options? 400. What did you have if you made the optional entry? Again, 400 in APEC options. So either way can be used. I will let you know which way I want on the next exam. But the effects are exactly the same. The net effect of all of those entries is to charge $400,000 to expense and to have a credit balance sitting in additional paid-in capital for stock options. Same effect overall. Now, the difference, if you went with the optional entry, you'd have to make a disclosure anyway in the footnotes, but that is I guess, a preferred form of disclosure. And then, of course, you'd have to also indicate in the cash flow statement that it is a non-cash financing activity, significant non-cash activity. And with the no entry case, of course, you would just make a disclosure. In either case, when you debit comp expense, how does that affect cash flow? It doesn't. So what do you do with the comp expense in the cash flow statement? Anybody? It's like depreciation. Okay, and it's an add back. It's a non-cash expense. So just like the bad debt expense, just like depreciation expense, we add this back. Now, one of the things I like to do, and hopefully we'll get to that, is at the end of the semester, I'm going to work you through the cash flow statement again, but we're going to focus on everything we've covered this semester. So it'll almost be like a review class or a capstone. How do leases affect the cash flow statement? It's an operating lease, again, whether it's a capital lease, whether it's sales type, whatever it may be. We'll look at options and how they affect comp expense, or how comp expense affects the statement of cash flows. Okay. Any questions on the two approaches? Again, the accounting itself is not difficult. The problem is the terminology and understanding the contracts. So just make sure that if you have any questions about any of the contracts or any of the information, you clear that up with me, or make sure that you understand it before you try to approach any of these questions. Now, what about exercise? So now we have someone doesn't quit, no forfeitures, individuals come through for the 2 years, they vest. Vesting means that they have the right to the options, whether they stay with the company or not. The other way to look at it, your right does not change now whether you leave the company. It's no longer dependent on your employment. Now we're going to exercise. So let's say you exercise, and on January 2nd, 2013, the options are in the money, and you decide to exercise. That $17, I'm going to tell you, is only there for logic. It does not affect us because we're not using a net settlement. We're not going to bring that into the accounting at all. However, if there was a net settlement, when you go on to practice, some of these options could be settled where you take the 17 bucks and subtract it and say, you know what, I'm going to give you $13 a share in cash. So in other words, why buy the stock from me and then go sell it? I'll just pay you $13. That's a net settlement, and we're not going to consider that. So we're going to assume that you could sell the stock for $17, but you got to buy it from me first for $4. Now, the logic behind this is important because right now, I'm going to issue stock in non-monetary exchange. What did I get for those shares? I got cash of 200. Why? There's 50,000 shares, and the exercise price is $4. Right? So you have to give me $4 a share. 200,000. What else did you give me? You gave me a service that was worth 400. So it's a combination of a cash and a non-cash exchange, but the total value of the services that I received from you is 400 plus the 200 in cash gives me 600 in total value received. If the par value of the stock, which it is $1, the excess goes into paid-in capital in excess of that. So when you exercise, you're going to debit cash for the amount you receive. You are going to debit the APEC options, which no matter how you record it initially, is the same. It's 400. And then you credit common stock at par and credit additional paid-in capital. Now, again, the number up here, 17, could have been 20, could have been 120, could have been $2,000 a share. Whatever it is, it's not going to affect the accounting. The accounting is based off of the fair value of the services rendered plus the cash paid to buy the shares. And again, this entry is not dependent on the initial recording. This entry is the same whether you recorded it with the optional entry with deferred comp or unearned comp, or you didn't make that entry. So it's not dependent on the entries. And then finally, and I'll take some questions if you have them, if the stock goes underwater, it is no longer in the money. So the stock is out of the money, market price is $2, exercise price is $4. You're not going to buy it from me for $4. If you want the stock, you'll buy it at $2, so that you don't exercise. The period ends after 5 years. Options expire. If the options expire, I simply reclassify the equity. I debit APEC stock options and credit APEC for expired options. Basically, you gave me the service, I expensed it, but I didn't have to give you any stock. It was almost like you contributed your services. It was like donated services. You didn't have to get any cash, and you didn't get any stock. Once again, normally, I'm not picky on titles, but you can't debit APEC and credit APEC. It's got to be APEC stock options on the debit side, and you have to credit APEC expired options. Now, that takes us through, and I want to see if you have any questions, a relatively simple accounting, but again, I'm not downplaying the importance and somewhat difficulty of understanding some of the nuances of the option contract. The good thing is, you don't have to worry about is we will give you the fair value. The fair value of the options based on a Black-Scholes or a lattice model, whatever it is, I'm going to give you that number. Now, what does become complex is the vesting probability or the change in that vesting probability. All right, so any questions regarding accounting for employee options? 2 issues: measurement, its fair value, allocation, and then the debits and credits. Now, what does become a bit of an issue is when we have a change in the vesting probability. So if you go to page 7, I'm not going to do all the entries here. Just going to go like this for now. This table is very common, or a calculation like this is very common. Let me make sure it's focused properly. When you look at option or employee compensation contracts. So here is our initial situation where, let's bring this down a bit. We assume that total compensation expense is given to us, the fair value is 400. And before I do the change in vesting probability, let me show you how this would work. You've got 100% vesting probability. The expense is 400,000, and the amortization is over a 2-year period. Now, the thing to remember is that we work with, on these tables, we're working with cumulative rate of amortization. So for the first year, it's 50%. You expense 200 less what was expensed in the prior year. Why? It's cumulative. Nothing was expensed. It's the first year, and comp expense is 200. Now, to show you what this would have looked like, if we didn't change the assumption, what is our simple case, the case we just finished? We've got 400,000, nothing changed on the comp, because we wouldn't change its equity classified. The probability of vesting didn't change in our example. So you would have had 400 is our total expected compensation. And now the rate, the cumulative rate is 100%, because you're fully vested. And therefore, we should have expensed 400. Prior years, you expense 2, and therefore you expense 200 in this period. So that's exactly what we're reflecting here. 200 in the first year, 200 in the second year. I mean, it looks kind of elaborate for a simple, take the number and divide it by 2, but there's a reason for this. The reason why these tables or this type of calculation is going to be used in practice is when there are changes in vesting probabilities. If there's a change in a vesting probability, things become a lot more complicated. So let me show you that right now, unless there are any questions here, the way this would be set up. It's very simple, just dividing it by 2, but you need to think of this as a cumulative schedule. I'm now going to assume that the forfeiture rate changes. I'm now going to assume that we have expectations that only 40% of our employees will vest. 60 will forfeit. Let's see what happens. First year, we already did this. Now you're in your second year. At the beginning of 2012, you're saying, well, look, I know I expensed 200 here, and my vesting probability in that first year was 100%. Now the forfeiture rate goes up to 60. I only expect 40% to vest. Problem now is that I have to adjust compensation. This is an equity classified award. Although we do not change for changes in market price, we have to adjust for changes in vesting probability. The problem, of course, is easy to understand if you think about the following. If you leave, if 60% of our workforce leaves here, I have less compensation expense, you provided less service, and I have to adjust that number. So Once the vesting probability changes, then we have to make adjustments. And here's the way the adjustments look. You start off with your fair value at 400, but now your expected vesting is only 40%, and your expected comp is 160. And since everybody's fully vested at this point, and you expect the total comp to be 160, well, obviously you got too much in there, and as a result, you're fully vested, you have to unravel 40,000 of compensation, which means that in period 2, you actually have comp income of 40,000. Now, we treat this as an adjustment in the current period. We don't go back to prior years. Why not? What kind of an adjustment is this? What kind of a change? We talked about accounting changes last semester. Change in principle or change in estimate? Estimate. Estimates are done how? Prospectively or retrospectively? Prospectively. So this is a prospective change. And that's why when you ask the question, I'm saying, I've been trying to do some research on this, because I got a feeling that companies might play with vesting probabilities, not only here, but in other areas of compensation. And it's not that clearly disclosed. If this was clearly disclosed, we would be able to get a wealth of information the way we do with write-offs of obsolete inventory, and the way we see the way people change the bad debt allowance. So it's the same idea. So what you could have done is you could have, if you had a lot of income in this first year, if it made your vesting probability 100, now maybe you change the vesting probability. It's only an estimate. It's only an estimate. So it is a change in estimate, and it is going to be prospective in nature. So I need to unravel, or I have to adjust compensation by adding 40,000 back to income. Now, how do I do that? It's pretty simple. I'm going to use the no entry case. I'm not going to go into too much detail. If anything, this is all I would ask you to be able to do. If you think about the case where you didn't make an entry on the date of the grant, I have these T accounts right below. You don't have to copy them. And what I want you to see is that right now you've expensed 200. You should have expensed what? 160. If I can go back and look at the table, should have expensed 160. APEC options is 200,000. It should only be 160. So the entry we make, you can see the T accounts right below it, is going to debit APEC options for 40, leaving you a balance of 160, and you're going to record comp income of 40. And that gets closed to retain. And that increases income during that period. It increases income during that period. And of course here, you can see that the balance is a credit balance of 160 in the options account, and comp expense is going to be really income for that period. So in adjusting the changes in vesting probability, there could be lower expense, higher expense, or even income being recognized during that period. And then, of course, if we assume, and I'll go back to this in a minute if you have a question, but if you assume, and I'm not going to do the second case, B, with the optional entry, but if you assume that that 40% holds up, on the bottom of page 8, you would basically be able to say that, all right, I had 50,000 options for 50,000 shares, If 40 actually vests, then 20,000 shares would be issued, and at a $4 strike price, I'm going to get $80,000, then plus what? Services worth how much? 160. And then, of course, I'm going to get common stock at par and excess over par. So that would be the entry, and that would be the same entry no matter who, no matter what entry you make at the date of the grant. But in our case, we're assuming no entry was made, just to make it simple. Or to keep it, it gets a little bit more complicated if you made the optional entry. All right, so questions. Let's go back and think about the adjustment. Any questions on the adjustment? Does everyone understand that somewhere at the end of 2011 or the very beginning of or even during 2012, we changed our vesting probability? Can't be at the end because you know the actual result. And you come up, I know that it would probably be more realistic if I had a 3-year time frame. Makes more sense, and now you kind of at the end of the vesting period. But in any event, questions on they can recognize income, so they lower the vesting probability. If they lower, they can increase it. Well, yeah, it would probably, as I said, it's probably going to make more sense if this was like a 3 or 4 year vesting period where these changes are being made constantly. Now at the end of the vesting period, you're saying, I kind of know who vested, right? But so I just wanted to keep it compact. But in reality, let's say there's a 3rd period, and then obviously you would adjust there to the end. And this would actually wind up being the actual in this case. At the end of the vesting period, this would be the actual result, but only 40% vested. And that's why when you get to this point, 40% exercise. And the other 60 forfeit. And I want you to be clear about forfeiting versus expiration. If you hold it for 2 periods, you didn't forfeit. If you don't exercise because the stock goes out of the money, it's expired. If you walk out before the 2-year period, then you forfeit the award. And there is no adjustment during the exercise period. The only adjustment we make here for the vesting probability is during the vesting period. Right, so that's an important point. But this only occurs during the vesting period.
Do you have the stock options from the Treasury stock?
Yeah, it just complicates matters because what will happen is that in credit Treasury, first of all, if this was the retirement method, it wouldn't change it. Right? This is newly issued shares. If it was the cost method, then you have the problem of whether or not there's a gain or loss on the Treasury. So if the Treasury stock cost was $240, there'd be no gain or loss. If it was more than $240, there'd be a loss. You have to debit retained earnings or APEC from Treasury stock. And if the cost was less, then you would have gain on Treasury, and that goes into APEC. So just, yeah, I mean, in reality, these options would be satisfied through Treasury. But not to convolute it or to sort of build in another issue. We're assuming they're newly issued shares. So we always assume they're newly issued shares to avoid the gains and losses on Treasury transactions. Any other questions on the equity classified awards? Now, there are also liability classified awards. And we're going to now look at, this is the appendix of the textbook. and there are liability classified awards. Now, the awards are easily identified as liabilities for a lot of reasons. One, as you can see, if you have options to acquire redeemable preferred stock, redeemable preferred is a liability. So if your option is to acquire a security that is a liability, then we classify these as obligations, not as stockholders' equity. If you have the right to sell back the stock after a certain period of time, then of course, reasonable period of time, you have no risk. The employer has all the risk, and therefore it's not considered to be equity, it's a liability for the corporation. And then you can also have options or awards that are linked to a factor or a stock price, and those are also considered liability classified awards. Now, let me just change this. And tell you that liability classified awards we value at the grant date and we change value for changes in market price. So you do adjust the value. If there are fluctuations in market price, if there's fluctuations in an index, a commodity price, whatever you're using. So the value of liability classified awards are going to be adjusted based on changes in market price and, of course, for changes in vesting probability. Now, the real issue here, let me just clean this up a little bit. The real issue that makes this different is not only are you going to be adjusting the options value during the vesting period for changes in market price, you're going to change the value even during the exercise period until they expire or they're exercised. So this revaluation of the liability takes place throughout the life of the contract, not just the vesting period. So let me say that again. It's extremely important that we are very clear that the revaluation of the liability takes place throughout the life of the contract. That is, until it expires or until you exercise. So even during that exercise period, if the value of the stock changes, the liability I have to pay you is going to change. And therefore, until you actually exercise or until it expires, I'm going to revalue. I'm going to revalue the obligation. All right, so that's a key difference. Changes in vesting probability, of course, would take place during the vesting period, and then changes in value would take place throughout the life of this contract. And this again would be for a liability classified. All right, so let's take an example. And this comes from your textbook. And one example of liability classified awards are stock appreciation rights. This is on page 9. Stock appreciation rights are, by the way, all of these, I guess, alternatives to employee options have become very popular over the last 15 years since, or at least 13 years, since the expensing of options became mandatory. So once corporations had to start expensing options, they came up with other alternatives. Stock appreciation rights are contracts that would pay you on the increment in stock price over a fixed price or a pre-established price. It looks like an option, but it's not. You don't get stock, you get cash. So that in this example, we have a plan that's set up on January 1 of 2012. We then have the plan telling us that you will receive rights. Those rights are in value of there are 10,000 rights. The pre-established price is $10. If the stock price goes above that, you get the benefit. If it goes down, you lose. If it goes below that amount, you get nothing. So the stock appreciation rights are rights to get paid based on the change in stock price, the change in a market index, a commodity price, whatever it is, could be based on net income over a certain level, whatever the performance level is. If you go above that level, you will get paid the excess. Now, there's a 2-year period. Service period is 2 years, and the initial price is $13. So let me first bring this in a little bit and work on some of the information we have. The information that's given to us in this problem tells us that initially market price is 13. The fixed price or the target price is 10. So the value of each right is $3. You have 10,000 stock appreciation rights, so your value is 30,000. And that becomes the total of your comp expense. Now, it's cumulative, and remember the table that we had before? That's cumulative. So let me bring this in a little bit more. So now, I'll erase that. %50 is vested so that your comp is 15. So in the first year, comp is 15. That's half of the 30. Then, we bring it back again. I know it's hard to see, but kind of stuck with this right now. Stock price goes up, 17. Pre-established price is 10. The fair value of the right is 7. You have 10,000 of them. So right now, the total amount of the compensation is 70. You are now fully vested. This is a 2-year vesting period. So 100% of the 70 is now fully earned. However, since you've already, and I'll move this over in a second, since you already recognized 15 in the second year, I have to recognize 5,500 of comp expense. So the total expense right now is 7. In year 1, I pick up 15, and in year 2, I pick up 55. And once again, we're back to that cumulative schedule I had before, which, as I said, is used quite often for these types of contracts. So again, 70 is the total, 15 in year 1, 55 in year 2. Now, finally, in the last year, the market price drops, and the executive will exercise at the end of 2014. But here's the very, I guess, critical piece for you. I'm now in year 3, and I've already vested. First of all, I'm changing every year. I could complicate this with a vesting probability change, but I'm changing every single year based on the changes in the market value. Then you might think, well, okay, they're fully vested, that's what I owe them. If they keep working for you, you still owe them more money. It doesn't end at that point under this contract. But the executive might have got a little greedy so that at the end of 2014, price drops to $15. Now the rights are only worth $5 each. And with the rights being worth $5 each, now I only owe you $50,000. And the fact that I've already expended 70 means that I've got to take back 20,000. So when you get a 3, I now have recognized, or I will recognize, 20,000 of income. So I will unravel, again, on a prospective basis, based on estimate changes, basically, you'd have to unravel that amount. And you take that into comp expense. Now, for the journal entries, on the bottom of page 9, let's bring that back in a little bit so you can see it. In the first year, I'm going to expense 15. And by the way, as I told the other class, in the first class, kind of easy, accounting 101. Once you get the numbers, it's like salary expense. It's like debiting salary expense, crediting salaries payable. Here, just got to know the terminology. You debit comp expense and you credit the liability under the stock appreciation plan. 15,000. Next year, same thing. Go to the next page. The entry looks the same. Numbers are different, of course. So you debit comp expense for year 2, credit the liability on the stock appreciation plan, and then the third year is where we take it into income, and that means that we're going to, sorry about that, we're going to take the income back. So we debit the liability, we reduce what we owe you, and we now have comp expense at 20 credit, which is income. Now, if you think about the liability, it's going to go now. So we have a liability. This goes on the balance sheet. So at the end of the second year, that was 70. At the end of the third year, there's a balance in that liability account of 50, just like salaries paid, same thing. So you have liability of 50, and if the executive at this point decides to exercise, I would have to give him $50,000 in cash. And that's exactly what happens. So at 12/31, the executives decide to exercise those rights. I debit the liability and I credit cash. So again, it's like accruing salary, debit salary payable, debit the salary expense, credit salary payable, then when you pay it off, you debit the liability for comp and credit cash. So once again, it's the contract that you have to understand. The debits and credits are not all that difficult. And you also need to remember that if this was an equity classified award, there'd be no adjustment throughout the vesting period, the changes in stock price, and certainly there'd be no adjustment beyond the vesting period. If it was equity classified, the only thing we can do is change the amount of comp during the vesting period for changes in the probability of forfeiture. And that's it. All right. So questions now on stock appreciation, or I should say, liability classified awards in general. I should tell you that liability classified awards, in some cases, could use option pricing models. I mean, if this was a stock option to acquire a redeemable preferred stock, you would use an option pricing model. You could use an option pricing model for that. All right, questions on liability classified awards so far? Got one more to go. Now, we do have restricted stock, or one more topic to go. Restricted stock plans are equity classified. And on page 10, I'm going to show you an example in a minute. Well, actually, I left this here, which is pretty good. So let me show you, or tell you what these are all about. When you have a restricted stock plan, and these are becoming very popular again now that we've got, we're forced to expense options. A restricted stock plan is quite simple. I issue shares of stock to you in your name. You're now the owner of those shares. However, you can't do anything with them until you meet certain restrictions. So, for example, you have to work for me for 2 years. You have to have performance at a certain level. You have to bring in a certain amount of new clients. You have to open up X number of new retail stores, or you have to expand our online sales. Whatever the target is, whatever the restrictions, you cannot take possession. You legally own them, but you're not permitted to use them. You can't sell them until the restriction is satisfied. Now, there's a lot of issues with respect to those dividends. If there are restricted shares and there are dividends paid, in some cases you can get the dividends. In other cases, dividends go into a trust for you. So that's complications that sort of beyond what we're going to be doing here. But why were these popular? Well, let's take the advantage. I have to leave this up from the last section. So let's take a look at the advantages of restricted stock plans. And again, these are equity classified awards because they're stock. First of all, for an employee, where are the advantages? About 4 advantages here, I guess. I just summarize them. You have immediate ownership of the company. You don't have to wait. You're an owner of the firm. You have no cost to acquire the shares. It costs you nothing. Just give them to you. It's like a bonus or an award. Unlike options, the shares will always have value, unless the company is what? Dissolved, liquidated. So an option could go underwater, right? If the market price falls below the strike price, options are worthless. Here, if the market price of the stock falls, you still have some kind of value, right? So there's still value. And finally, they are taxed as compensation, ordinary income, but only when the restrictions are satisfied. Now, if I paid you in shares of stock, if it's payment in kind, sometimes they could be taxed. But in this case, because you really can't do anything with them, you can't sell them, there's no in-kind or there's no cash equivalent. So I really can't, it's not what they call a constructive receipt, if I'm correct. You've heard that term? In tax, constructive receipt, where if I give you shares of stock, it's really a matter of you just selling them and you get cash. Here, there's no constructive receipt until the restrictions are satisfied, because then you can sell them. From the employer, yeah, I love to be too good. From the employer standpoint, advantage, you get immediate equity ownership. It looks the same, but the difference from the employer's perspective is, look, I'm making you an owner of the company right now. You have more incentive, hopefully, that you now have ownership and more motivation. And not only that, since I'm making you an owner right now, since the shares will always have value, or because they'll always have value, I could probably get away with fewer shares than I would have to issue if this was an option. So there's less dilution. So the immediate equity ownership, the good thing is, again, is that there's probably more incentive, more motivation. I'll probably have to issue fewer shares, because don't forget, the shares always have value too. And I get a tax deduction. So as soon as the restrictions are lifted, I get a tax deduction. Unlike qualified options, because with qualified options, I mean, first of all, if you have any leverage as an executive, you want a qualified option. You don't want to have to pay tax when you exercise. So if I have to get exercise, if I have to get stuck as a corporation with a qualified option, as I showed you, I get no tax benefit. Here, I get the tax benefit when the restriction is satisfied. And the fourth, I guess, advantage here, or the third advantage, is that the comp is based on the market price of the unrestricted shares. So I don't have to use an option pricing model, right? Don't need an option pricing model. I simply take the value of the unrestricted shares and multiply it by the restricted shares, and I get my value. So it saves money in estimation. It also may result in a lower value. May result in a lower value. All right, so those are the advantages, and they're becoming extremely popular. Now, the accounting for this is actually pretty easy. It is, in fact, going to be, I think, much easier than most other things, or most other forms of compensation we look at now. Let's go to the example. And by the way, let me, forgot to at least show you this. I mean, it's not a, I've already said it, but just to tell you where it is. In terms of the restrictions, on page 11, there's a list of possible restrictions. You know, you have to stay with the company for a certain period of time. You also have performance-based awards and so on. Also telling you that the comp expense, if you look at the very bottom of the screen, comp expense is the fair value, the market price, perhaps, of the unrestricted shares, times the number of restricted shares that we get. And again, you could have forfeitures, the same thing. Comp expense is going to be amortized over the vesting period, and forfeitures, like any other equity classified award, are going to be accounted for on a prospective basis. Now, let's get an example. We have Ogden Company. This is also on page 11. Sorry, just losing a step here, looking for the computer, and it's not there. And we issued restricted stock, 1,000 shares, to the CEO of the company on a date when the restricted stock had, or at least the unrestricted stock, the stock that's trading currently, had a market value of 20. Again, we'll assume that it's newly issued stock and not treasury. Here are the restrictions. You have to stay with the company for 5 years. And vesting occurs at that point, and the par value of the stock is $1 per share. So the restricted shares on a 5-year vesting period, and again, they are valued very simply at the price of the current or the unrestricted, currently trading or unrestricted shares. So on the date of the grant, you make this entry. You debit deferred or unearned comp. This could be deferred comp, I don't really care. And you credit common stock at par and excess over par for 19. The unearned comp is 1,000 shares times $20 a share. Now, this is not, I mean, if I give you this on the next exam, this is not an optional entry. Why? Stock is being issued. It's not an option. It is an actual issuance of common stock. So you do not have any choice. You must make this entry. This entry has to be made. you have to debit the deferred or the unearned comp, which is negative equity in the stockholders' equity section, and credit positive equity, 1,000 for par and 19 for the excess over par value. So that you have this account, once again, negative equity account. Sitting on the stockholders' equity section as negative equity. Then, very simply, the vesting period is 5 years. So you simply straight line that over a 5-year period. So every year, 20,000 divided by 5 years, take 4,000 a year. So 2012, is it 11? 11, sorry. 12, yeah. 4,000, 4,000, all the way through. Debit comp expense, credit deferred comp. And that's it. Now, the key right here is that once the employee fully vests and you've written off all of the comp, obviously if there are changes in vesting probability, you'd have to change that. You don't have to do anything else. Why not? Shares are already issued. If this was an option, you'd have to issue the stock, correct? If it's an exercise. Here, all you have to do is work for 5 years and you're done. You already got the stock, now you can sell it. Or now you have access to it. So the trick here is to really sort out the differences in these stock plans, or to make sure you understand how these differences work. So there's nothing you can do. Now, in the event that there is a forfeiture, so if this person walks out, let's say after 2 years, this person walks out after 2 years, you basically just reverse out the equity issue. You take the stock back, and it's almost like a retirement, I guess. You would debit, you take them and put them in unissued shares. So now they're going to take them from the issued stock and put them into unissued, just like the retirement method. You're going to debit common stock for 1,000, debit APEC on the common, and you are now going to bring back, it's the third time we've seen this, for an adjustment for forfeiture. You would now credit comp expense, goes into income, and you would credit the deferred comp account on this adjustment. So for the forfeiture, you have to eliminate this account. So in the event that a forfeiture takes place, you take the stock, it goes back into unissued shares, you take back the compensation expense, you bring it back into income, you reverse it and take it back into income because you assume this happened 2 years out after these first 2011, 2012, and 13, I should say, 2012 and 13. 8,000 in comp expense has to be brought back into income, and unearned comp is removed. And again, change in estimate, and it is a prospective adjustment. All right, any questions on the restricted stock? Once again, I know you're not worried about this now, but when you have to worry about it, make sure you sort out the different types of compensation plans, how they're similar and how they're different. I think one of the things you're noticing is that with forfeitures or adjustments, we take it back into income. Somebody said, to me, well, I thought you're not supposed to credit expenses. Well, in this case, you do. You're able to take this back into income. Now, I do have in the notes an example of PepsiCo, but I'd rather not use that. And I also put this up on Blackboard, but I assume you wouldn't be able to print it today or you forget. So this is General Electric. What I like about General Electric, it's almost like teaching out of a textbook. It's really good. Actually, they don't do this anymore, but if you look at the old, yes, one more. If you look at the older versions of General Electric's annual report, they would give you all of their subsidiaries and show you how they were consolidated. It's really like take the parent company and all the subs. Okay, so let's take a look at this footnote. And a couple of things to notice on here, and then we'll do a couple of questions. I want to make sure we're not going to be able to use clickers, obviously. So. The first thing you look at, and these disclosures are standard, but GE's got a much, much better looking disclosure, much more transparent. If you look at the two columns, you've got, or at least the two categories, you've got exercisable and outstanding. What's the difference? Exercisable and outstanding. So what's the difference there? Anyone know? Yeah.
It would be the total minus the exercisable. So those that aren't vested yet would be outstanding.
It would be the total minus the unvested, or ones that have not vested. So these have vested. These have vested. Now, when we do earnings per share, and again, unfortunately, this course is, as I said, it just keeps building. So we need to know this for earnings per share. When we use earnings per share, when we do an earnings per share, we will look at options that are in the money, right, but outstanding. So it may be a little conservative, because we're taking all options and assume that they have dilutive effects, that they will dilute earnings per share. Really, exercisable options would make more sense. In financial analysis, you use either. So for example, if I was trying to value, if I was building a model to value a company's equity, and I wanted to build in the potential dilution, I would use exercisable. However, if there was a merger, I would use all outstanding options. And why is that? Does anyone know? In a merger deal? What happens if a company buys another company and you have options and you're not vested yet? They automatically usually become exercisable. There's something known as change in control provisions. So if you get paid in options, I'm going to have a change in control provision there that says if the company changes control, I have the right to exercise those options. So if I'm doing a merger model, I would use all outstanding options. But for us, not worrying about the financial analyst, we're going to use all options. Now, what options are in the money here? What do you need to know? I got the average exercise price. What do I need to know if options are in the money? How are they in the money? Market. I got to know the market price. So, for example, if the market price is $23, then any of these options from $21.57 and up would be in the money, and they would be potentially diluted. Anything below that is out of the money and is not going to be potentially diluted for my earnings per share calculation. So that's one way to handle it. What I've seen most people building models, you just kind of draw a line across here, and then based on their stock price, they would be able to determine what's in the money and what is not. Also, if you look here, it's another really nice disclosure, which indicates that we have options at the beginning of the year, how many were granted, how many were exercised, how many were forfeited, and how many expired. Also, if you look here, and this is the question you had before about expected vesting probability, they will tell you how many options that are expected to vest. So I would look at the outstanding and look at the exercisable, and the difference between those two that's right, yeah. I've got about 219,000. If you take the difference between those two, I've got about 220,000 options that are not vested, right? Because I've got total at 473,611. I've got vested options, because they're exercisable, 254,003, and these others are not yet vested. If I take what I expect to vest out of that, it's about 91%. So there's a vesting probability of 91% and a forfeiture rate of 9%. And what I'd like to do eventually with some research, if I was able to get more of this, is to track these probabilities for a lot of companies, but it's just not there. They're just not, the information is buried lots of times and you just can't get it. It's not easy to see. But anyway, you are able to get the vesting probability in this case. So that's one thing that's pretty good about this disclosure. It's very transparent with respect to the vesting probability. And of course, on the back of your handout, you'll see that we talk about how the options are valued. This is pretty common. And, they use the Black-Scholes option pricing model. And they have the fair values that they use. They also talk about the assumptions. They'll talk about the interest risk-free rate, dividend yields, stock price volatility, and the expected lives of the options. And as I said, if you really know enough about Black-Scholes, you know that beyond a year and a half to 2 years, it's extremely inaccurate. These are way beyond the accuracy level of that model, but we still use them because they are, of course, considered to be just estimates in this case. You also get information, and this is something that may not mean much to you right now, but we are going to see that we've got 663 million of unrecognized costs on the unvested or non-vested options. That's basically the potential expense that we will be hitting our income statement with going forward. That's the expense on the options that have not vested. So for example, in our illustration, we had 400,000 in total expense. At the end of year one, we expense 200. The non-vested portion is left over is 200. That becomes important to us when we do earnings per share. We do consider this to be cash. The fact that you've got compensation that you're not going to have to pay, it is like excess cash for the company. And then we talk about the fact that you are going to expense those at 180 per year. And stock option expense, we tell you how much has been recognized over time, how much cash, and of course the tax benefits if these options were non-qualified or if these are stock appreciation rates. This is not the full footnote. They did have some stock appreciation rates which give them tax deductions when you get the restrictions satisfied. So just to give you an idea of what is in that footnote. So there's your typical footnote. The PepsiCo example is somewhat similar, but this one is actually a lot better. All right. Now, last but not least, I just want to go over a couple of questions with you. You don't have clickers, but well, you can't use the clickers, I should say. So let's take a look at a couple of these questions. Let's take the first one, and it says, if a vested employee fails to exercise an option before its expiration, the company should decrease comp expense. So do we change comp expense for expirations?
Does it change during the vesting period?
It's a good question. So let's discuss this. It doesn't. It says they were already vested, right? So if you look at the wording, so it's just basically saying that the options expired. So what do we do when they expire? If it's an equity classified award, you simply reclassify the APEC options into expired options. So there's no comp expense adjustment for this at all. It's just a matter of an expired option with a reclassification of that APEC. Now, of course, that assumes it's an equity classified award. If it was a liability classified award, what if that was, it says a stock option, so you really can't say, but if it was, let's say, a stock option for redeemable preferred stock, and it was classified as a liability, then that liability's got to be removed from the books, and you might have some comp expense adjustment there. You might, because you don't have equity, you don't have an offset in equity. Okay, let's look at, so that one's false. Let's look at the second. In the fair value method, companies compute total compensation expense based on the fair value of the options on the date of exercise. Date of exercise. Right. It's got to be at the date of what? The grant. Yes. Only at the grant date. The only way this would make sense is if this was a liability classified award, like a stock appreciation right, where at the end of the term, remember the example we gave you, the comp fell by 20,000. So, but no, for options, no. We didn't say stock appreciation rights here, we said options. Okay. Number 3, a stock restricted stock plan, measured on the date of the grant by using an option pricing model. This one is just by definition. Yeah. Yeah, and you do it not at the grant date. I'm sorry, you don't do it at the exercise date. You do it at the grant date, right? So it is grant date. It's the fair value of the unrestricted shares. And number 4, liability classified awards are measured at fair value on the date of the grant and are adjusted for changes in both market price and the number of awards expected to vest. Liability classified is true. Yeah, you do both market price and the vesting probability. Do I have it? I had it. It was here. If it's an equity classified award, it's false. If it's equity classified, it's only the vesting probability change.
So which one's not adjusted for market price?
Equity classified. Yeah. All right. Well, let's try one more. Let's go to the last one, number 5. And this one, just a simple computation, I think. You've got Sharp, granted employee options, purchased 9,000 shares at $5 par. Strike price is $20. Black-Scholes Model gives you a fair value of $210. Options are exercisable, so you vested at 12/31/13 after you complete 2 years of service. Stock price on the grant date is $30. And on the exercise or on the date when you fully vested, it's $50. What's the comp expense in 2012? Anybody have it? Comp expense for 2012. Yes. C is, yeah, 105. It is actually that simple. And this is a CPA exam question, so it is pretty easy. Basically, this is an equity classified award. You've got the Black-Scholes model giving you 210. There's a 2-year vesting period. End of story. Divide by 2, 105 in the first year. Now, what does the fact that the options are in the money on the date of the grant? In other words, there's intrinsic value. Market price is 30, stock price is, or the exercise price is 20. There's a $10 intrinsic value on the grant date. What does that mean? Just really that it's a non-qualified option. That's all that means. It's a non-qualified option. And the stock price on the date that you are fully vested is 50. Just tells you that the options are in the money, but it doesn't affect stock price at all because it doesn't affect the option price at all or the value of the option because this is an equity classified award, not adjusted for market value. The only thing it would be adjusted for would be changes in vesting probability. Okay? All right. So we'll see you on Thursday, or maybe don't forget I'm in.